First off, during the trading day, the number one rule you have to keep in mind is the less amount of decisions that you can make during the trading day. In other words, the more things that you have thought out before that day opens, the better off you are. You don't want to be having to make multiple decisions during the trading day. So very first off the bat, you must have your unit size predetermined. Are you trading 5 lots? Are you trading 10 lots? Are you trading 2 contracts? So forth. So you must keep an even bet size in order to start achieving some type of consistency of numbers. The second thing, how do you exit? Exit strategies really should be predetermined, and they are set according to the initial trade setup. For example, in most of our quantitative testing, about 75% of the trade setups test out best exiting for a small piece only. By that, I mean, for example, saying, okay, I'm going to take profits at one ATR, one average true range function, or a test of the high, or a fixed target. Only about 30% at best, more like 25% of the initial trade setups justify a trailing stop management and exit technique. Now, it doesn't mean that once you're in a trade, you can't tighten up the stop to cinch profits, because it is very important if the market makes a move, you pull your stop up to tighten in the profits or lock in the profits you made. The majority of time what you'll find is that the shorter the time frame that you are trading on, the less justification there is for trailing a stop. The reason being, the shorter the time frame you go down to, the more you are trading in market noise. So your job is you're buying on bid, trying to sell on offer. You're not trailing a stop on the trade that you just bought. So if you are a short-term trader, especially a day trader, you need to be buying on bid or selling on offer at least 50% of the time. Now we're going to start talking about market environments. The less volume there is and the more noise there is, the more critical it is to work a bid or work an offer for your initial entry. If you missed the trade, so what? Let it go. You're in a noisy environment, and the odds that you're leaving a big win on the table are remote. However, there are other types of market environments which I call urgent market environments. And in an urgent market environment, that is one of the times that you can use a market order to enter. And the initial goal in an urgent market environment is just to get the trade on.